and welcome to the Monday Futures Market Outlook for September 26, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. 2 months ago, we crossed below this 80-week moving average, and it begs the question as to whether or not we've begun a new prolonged bear market cycle. We're going to be trying to analyze it on the daily charts in just a moment. As always, we just want to make some key intermarket observations. Obviously, the last 2 months have changed the landscape considerably. Now that we're trading below that 80-week moving average, it certainly is giving indications of a economic recession and a market consolidation. In addition to that, there's a very strong U.S. dollar. The U.S. dollar is being the safe haven of the world at this moment, as we see continued weakening euro, Canadian dollar, Aussie, and a number of other global currencies. This strong U.S. dollar environment will continue to dampen commodity prices. You'll see we still have even further downside risk on some of these commodity plays, and 30-year Treasury bonds continue to rally higher as the yield curve flattens into this environment. And we will look at the chart on that as well. When we take a look at that daily chart on the S&P 500, we more or less had that same flagging formation drawn on for the last month, looking for the tops to come in somewhere around these 1200 to 1250 area up above. Suggested that as soon as given a catalyst, this market should come for at minimum a retest of the previous lows, which is in this 1080 to 1100 area, and we more or less tested directly into that zone just now. But really at this stage, with the degree of the selling we've seen over the last 48 hours, it's quite possible that we actually exceed those lows. Some of the initial downside targets would be obviously the 1,000 to 1,020 level, which was the flash crash lows. But there isn't even a measured move that extends all the way down to even 950 on the S&P. While at this stage we continue to, and we're starting to favor the scenario that the double bottom doesn't hold here, and that the S&P still has at least one solid week of selling ahead of it as we get into those zones. Now, as much as that seems very concerning, we probably will see the lows of the year come in somewhere down into this wave of selling over the next week or two, and will probably emerge as a buying opportunity. But I think that it would be a little bit early to be accumulating stocks without seeing whether or not this 1100 level area holds on the S&P. When we take a look at the U.S. dollar index, we were drawing on that so long as there's a little flagging formation, that the U.S. dollar would resume back in trend and head up to the 79, 80, 81 zones up above. Really at this stage, we got a perfect breakout on the upside, and the U.S. dollar is really underway. There is some short-term targets up in this 80 area on the upside, but there are major highs up in the 81, 81.50. So at this stage, I think that the U.S. dollar index probably will have some further strength until it bounces its head at one of these overhead resistance levels. Next here, I want to take a look at copper and copper futures. Essentially, we had flagging formation drawn on, suggesting that copper shouldn't really exceed the 420, 430 area on the upside. When that flag would break, that we would have downside targets, the 340, 360 on the downside. Well, that now has been exceeded. The crash in copper in the last few days has been very significant, and has now worked its way down towards 320 on the downside on its print scale. Really at this stage, the 283, 320 area on the downside should contain most of this initial downside thrust of the copper futures, but at some stage there will, after even a month of consolidation, copper can even weaken further, well below $3. But really at some stage here, we're probably going to hit the short-term low on copper, probably within the next 40 cents below. Next year, I want to take a look at gold futures, and gold had a very dramatic drop, almost $100 an ounce. just on Friday. That double top along the upside that we've been talking about occurred right out below the 2000 level. We were suggesting that we should see the top end of gold develop in there in a range back down towards even 1600 on the downside. Really, with the degree of selling we've seen here, gold should feel some continued pressure, probably even another $60 an ounce downwards, and we'll see where the support lines hold. In the bigger picture, if this was an intermediate high on gold, it means that we probably will not see another gold rally probably until December, January, and so we should be continue to see, even for several months, distribution. It doesn't necessarily mean that gold has to go in a downwards motion, let's say down to $1,300 or something, but it does mean that it's likely that no rallies will really gain any momentum and distribution will continue. Next here, I want to take a look at crude oil. We drew on that same flagging formation on the upside on crude oil as we have on all the other markets. We were simply suggesting that a measured move lower can be even as low as $65 to $70 a barrel. We're now trading in the $80 vicinity, but there is lots of room for crude to still go if it really gains any downwards momentum here. But nonetheless, the best case scenario here for the bulls is a double bottom retest here of this 80 zone, and it holds that support line. But more than likely, if there's any further pressure early this week, oil should give this level out, and we could see $70 or lower on this next push. Finally, I want to take a look at that 30-year Treasury bond, and we were talking about how Treasury bonds were more than likely to still break higher. We set a target in the 145 to 150 area on the upside. We've now basically tested about the 147 handle on the Treasury bonds. At this stage, there could even be a move as high as even 152, ultimately, as the whole economy falls into a recession, and we'll continue to see a flattening of the yield curve, and the 30 years will always have the greatest pressure on that front. At some stage up at those higher levels, the 30-year Treasury bond will be a major shorting opportunity, probably over a several month span, but really at this stage we have to let the rally finish and see where the tops of Treasury bonds actually come in. That was your Monday Futures Market Outlook. Thank you for joining me.